How Zelle and instant transfers made check writing ancient. Picture this. It's 2016, and you're splitting a dinner bill with friends. Someone pays the entire check, and now you owe them $43. Your options? Hand over crumpled cash if you happen to carry it, write out a paper check like it's 1985, or promise to pay them back later and hope they don't think you're a deadbeat. Fast forward to today, and that same scenario plays out in seconds with a few taps on your phone. What happened in between wasn't just technological innovation. It was the systematic demolition of an industry that had survived for over 3 centuries. The weapon of choice? Instant digital transfers, led by a platform that most Americans had never heard of until it was already in their pocket, fundamentally changing how money moves through society and rendering the humble check as obsolete as the telegram. The modern check system was already showing its age by the time smartphones became ubiquitous. Every year, Americans wrote fewer checks, from 19.6 billion in 2009 to just 14.5 billion by 2015. The infrastructure supporting checks was a Rube Goldberg machine of inefficiency that somehow worked. Paper checks had to be physically transported between banks, processed through clearinghouses, and could take up to 5 business days to fully clear. The Federal Reserve operated massive check processing centers across the country, employing thousands of workers whose primary job was moving paper from one place to another in the digital age. Banks spent approximately $1.2 billion annually just on check processing costs, a figure that didn't include the labor costs of tellers handling check deposits or the real estate devoted to storing physical documents. Meanwhile, check fraud cost businesses and consumers over $1.3 billion per year, as criminals exploited the lag time between when a check was deposited and when banks discovered it was fraudulent. The average cost to process a single check ranged from $1.22 to $3.09, depending on the institution, making it one of the most expensive payment methods for banks to handle. Enter Zelle, though few people knew they were witnessing a revolution when it launched in June 2017. Zelle wasn't actually a startup disrupting the banking industry from the outside. It was the banking industry's own weapon, created by Early Warning Services, which was jointly owned by Bank of America, Truist, Capital One, JP Morgan Chase, PNC Bank, US Bank, and Wells Fargo. These weren't naive tech entrepreneurs trying to move fast and break things. They were established financial institutions that recognized the writing on the wall and decided to cannibalize their own check processing revenue before someone else did it for them. The genius of Zelle lay not in revolutionary technology, but in revolutionary adoption. Rather than requiring users to download a separate app or create new accounts, Zelle was embedded directly into existing banking apps that millions of Americans already use. Within its first year, Zelle processed $75 billion in transactions, a number that would seem quaint compared to what was coming. The speed difference between checks and digital transfers wasn't just convenient, it was economically transformative. A check deposited on Friday afternoon might not clear until the following Wednesday, creating a payment limbo that affected everything from rent payments to business transactions. Zelle transactions, by contrast, typically completed within minutes, operating on the same real-time payment rails that banks used for their own internal transfers. By 2019, Zelle was processing $187 billion annually across 1.8 billion transactions, representing a 57% increase in transaction volume from the previous year. The average Zelle transaction was $104, hitting the sweet spot between small peer-to-peer payments and larger business transactions. But Zelle wasn't alone in this transformation. Venmo, owned by PayPal, was processing $159 billion in transactions by 2020, while Apple Pay Cash and other competitors carved out their own niches. The combined impact of these platforms created a new expectation among consumers. Money should move as fast as information. The COVID-19 pandemic accelerated the death spiral of check writing by forcing digital adoption among the last holdout demographics. Small businesses that had relied on checks for vendor payments suddenly needed contactless alternatives. Elderly Americans, traditionally the heaviest check users, found themselves making digital payments for the first time. In 2020, digital payment volumes increased by 41%, while check usage plummeted to historic lows. Zelle alone saw transaction volume jump 60% in the second quarter of 2020 compared to the previous year, processing $307 billion across the entire year. Banks began closing branches at an accelerated pace. Over 3,000 branches closed in 2020 alone, eliminating many of the physical locations where people traditionally deposited checks. The infrastructure supporting the check ecosystem was being dismantled in real time as demand evaporated. By 2021, the numbers told a story of complete market transformation. Zelle processed $490 billion in transactions, nearly doubling its volume from just 2 years earlier. The platform was handling 1.8 billion transactions annually, with 120 million consumers enrolled across participating banks and credit unions. Check usage had fallen to just 7.2 billion transactions per year, representing a 63% decline from 2009 levels. More telling than the raw numbers was the demographic shift. Among adults under 35, only 18% reported writing a check in the previous year, compared to 47% who had used a digital payment app in the previous month. Even among older demographics, check writing was becoming increasingly rare for routine transactions. The Federal Reserve began shutting down its regional check processing centers, consolidating operations as volume continued to decline. The businesses built around check processing found themselves in an existential crisis with no clear path forward. Check printing companies like Deluxe Corporation, which had dominated the market for decades, watched their core business evaporate. Deluxe's revenue from checks and forms dropped from $2.1 billion in 2010 to $1.3 billion by 2020, forcing the company to pivot toward digital marketing services and business solutions. Companies that manufactured check scanning equipment, provided check verification services, and operated the logistics networks for moving paper between banks saw demand crater. The armored car services that transported checks between locations reduced their routes as banks consolidated processing operations. Even the companies that produced the special paper, magnetic ink, and security features that made checks difficult to counterfeit found their markets shrinking rapidly. The implications extended far beyond the obvious players in the check ecosystem. Accounting departments in businesses across America had to retrain staff and update procedures as digital payments became the norm. The concept of float time, the period between writing a check and having it clear, disappeared from cash flow management strategies. Banks redirected thousands of employees from check processing roles into other functions or eliminated positions entirely. The massive real estate footprint devoted to storing processed checks became unnecessary, though regulatory requirements meant banks couldn't simply throw away decades of paper records. Legal systems had to adapt to handle disputes over digital transactions that happened in minutes rather than days, requiring new protocols for fraud investigation and resolution. What makes this industry killshot particularly fascinating is that it wasn't driven by a single company destroying an established player. It was an entire ecosystem of traditional financial institutions and tech companies working together to eliminate their own profitable but inefficient business lines. Banks made more money processing checks than they did on digital transfers, but they recognized that consumer preferences were shifting irreversibly toward instant gratification. By 2023, Zelle was processing over $629 billion annually, while check volume had fallen below 3.8 billion transactions per year. The infrastructure that once supported 50 billion checks annually had been largely dismantled, with the remaining capacity serving primarily businesses in niche industries that still required paper documentation for regulatory compliance. The death of the check industry represents more than just technological progress. It illustrates how consumer expectations can fundamentally reshape entire economic sectors within a few short years. In 2017, waiting 3 days for a payment to clear seemed normal, if mildly annoying. By 2023, Any payment system that couldn't deliver instant results felt broken and antiquated. The companies that recognized this shift and positioned themselves as the solution, whether traditional banks building Zelle or tech companies like PayPal expanding Venmo, captured massive market share during the transition. Those that clung to the old model of paper-based processing found themselves managing a shrinking pool of transactions with fixed infrastructure costs, creating a death spiral that accelerated their exit from the market. Today, writing a check for routine transactions marks someone as either very old or very stubborn, and the 300-year-old technology that once moved trillions of dollars through the economy has been relegated to niche applications like rent payments and government transactions. The instant transfer revolution didn't just make checks obsolete, it reset consumer expectations about how quickly money should move in the digital age, creating a new standard that every payment method must now meet to survive.